Hey traders, Clifford back with another video on trading the charts. Today I wanted to take a step back and talk to you about what I believe is one of the best markets to trade called the S&P 500 Micro Futures. With that being said, let's get started. Now, first and foremost, I just want to say, of course, I'm not a financial advisor, and these videos are meant for educational purposes. Futures trading is considered one of the high-risk asset classes, and it's not suitable for all investors. So definitely do your research before you decide if this asset class is for you. Okay, so with that out of the way, let's get into it. I trade the Forex, I trade the futures, and I do trade a little bit of the stock market as well. But I believe the S&P 500 is a great asset class, and here's why. So this is the futures market, so it's a little different than the stock market or Forex. But basically, what it is, there's different ways you could trade the S&P 500. Most of you probably know the S&P 500. It's basically an index that tracks the stock market of 500 of the biggest companies there are. So rather than you having to do research on, like, I don't know, 8,000 stocks or something like that, you could just trade the index. It's probably the easiest market to trade, in my opinion, and it's been going up for the last 10 years. So it's a pretty easy market to trade. There's different ways you could trade it. You could buy the index directly through a broker. You could buy what's called an ETF, I believe. It's called the SPX or SPY. But there's another way, and that's called the futures market, and that's what we're going to talk about today. So basically, why trade the futures? The reason I recommend the futures as a good asset class is because you can get a large return in a shorter period of time. It is considered a more risk, but it's also a higher reward. So let's take a look at that and show you what I mean. So basically, I have a demo account here. This is a simulated account with Ameritrade. Anyone can, open one of these. So this is like a simulated account. They give you a paper trading account, you could call it. So basically, the futures market, it's similar to the Forex, but it's a little different. Basically, they're traded in contracts, and the contracts have an expiration date. So like when you go, you could open up a futures account with any broker, of course. I'm not going to make this whole explanation about futures. Again, definitely check out my YouTube channel if you're new to that, because there's a lot of good sources there. But basically, these products are traded on an exchange, and they have contracts. So I'm just pulling up my Ameritrade account here, the simulated account. And as you see, there's all different types of contracts, from crude oil to gold to corn to all kinds of different commodities. But they also have the index contracts, which is what we're going to talk about, the S&P 500. So let's go to that. So basically, if you go to your futures here, it'll show you that here's a contract called E-mini S&P 500 Index. Now, the way futures work is you get to control a large asset with a deposit, and they call the deposit your margin deposit, basically. Okay, so similar to buying a house, if you put down a deposit to buy the house and then the value of the property goes up and you sell it, you make a profit. Same thing with futures. Instead of translated from real estate to the futures market, to a trading product, right? So if you put up, so here's an example. It's saying put up $12,000 to open this contract, right? And what does that do? Well, basically, it allows you to control 50 times the index. It's not showing you that here, but this $12,000 will let you control 50 times the index. And the way the futures market works is when you trade the S&P 500 index, it's going to pay you $5 per point, win or loss. I'm sorry, this is the big index, $50 per point, sorry, win or loss. So $50 per point, win or loss, with the big contract. Now, not everyone has $12,000. So a few years ago, the exchange created a new contract called the Micro S&P 500. And that's the one I'm going to talk to you about, and that's the one I trade. It's smaller, and you don't need as much margin. So here it is here. It's called the Micro E-mini S&P 500. And as you see, it's only $1,200. The difference is the point profit or loss is only $5 versus 50. Okay. But if you bought 10 of them, you would still be at a large contract size of, the big one. Okay. So that's basically how the point percentages work. And so here are the contracts, right? So here is the micro. This is the one we're talking about, the micro. And you got a 36-day expiration, you got a 127-day expiration, you got a $218 day expiration, and so on and so on. September, December, March. They basically use month codes to create these contracts, and they have a buyer and a seller, similar to any other asset class. Okay, so that's pretty much how the contract works. How do you actually trade it? Well, basically, you're gonna, similar to what I teach in my other videos, I use technical analysis to trade these contracts. But before we get to how to trade it, I do first want to explain how the mechanics work behind trading the futures. So you know that you have to put up the margin, okay, to open the position. So let's do that. So let's open one so I can show you. So here's the September contract. I think this one expires what, 36 days? That's plenty because we're just doing a demonstration here. So look, I go like this. I click on my broker, right? I click on my futures contract. Okay, I'm going to click buy one. Let's just buy one for the example here. We'll do a market order and send. All right, we are in the market. We are live on the S&P 500 right now. I mean, in a simulated environment, of course, but same thing. So now I go to position monitor, right? So what's happening here? Well, basically I bought one S&P at a price of 44.46 and 50 cents. Okay, that's the trade price. You're always going to be down slightly because of the spread. There's always a spread, just like stocks have a spread, like the spread here. You see the bid and the ask. If you don't know what the bid and the ask is, like I said, check out my YouTube channel. You'll see all the futures basics and learn about bid and ask. Basically, this is like the cost of doing business between the buyers and the sellers. So here we go. Okay, so basically the way it works is like this. Now they're giving us $10,000 in this demonstration. Okay, so here's how the futures work. You're going to make $5 per point, win or loss. Okay, that means if you buy the S&P 500 at 44.46 and it goes up, I don't know, let's say 20 points today, your account will go up $100. Okay, because your position is now worth $100 in that scenario. However, what is it at now? What is the S&P doing today? Let's just give an example, a real example here. So like today, the S&P, well, it's not doing much. It's kind of slow today, the S&P. I think it's only up, I'm switching to trading view so you can see easier. So it's up like 3 points. So, you're making 15 bucks right now. Obviously, that's like not like a big deal, of course, but you got to look at it from the long term, right? So I recently did a trade on the S&P here, okay, at 42.58. Now this from 42, or actually 42, yeah, 42.58, and it's now almost at 44.58, okay? So that right there, 42.58, 43.58, 44, if it gets to 44.58, that's a 200-point move. Now 200 points in the S&P 500 times $5 a point, that's $1,000 right there, okay? And that's a beautiful thing. However, what if I would have bought here at 42.58 and I was wrong and the market moved against me? Well, every time it moves against me, if I buy at 42.58 and it drops to, I don't know, 42, let's say it drops, It drops like maybe 100 points to 41.58, I would literally be down 100 points times $5. I'd be down 500 bucks. Now that's okay as long as I have enough money in my account. So when you open the position, like let's say you have $10,000 in this example, to open the position, the broker charges you the deposit, which is called the margin deposit. In this case, the deposit is $1,200. Okay, like I said earlier. So they take the $1,200 and they hold it. Okay, they hold it. It's like a good faith deposit, basically. And as the market moves, your margin stays with them, the deposit, until you close the position. When you close the position, of course, you get it back. Okay? So if the market rises and you're right, you're making $5 a point. I mean, if it goes up, like I said, 100 points, you're up 500 bucks. If it goes up 200 points, you're up $1,000. But if you're wrong and it moves against you, you have two choices. If, as you start to lose money, $5 per point, you lose 20 points, you're down $100. You lose 40 points, you're down $200. You use 50 points, you're down $250. So there's money that you can make and money you can lose. And I never sugarcoat anything. I want you to understand that, yes, there's money you can make and there's money you can lose. However, you have two choices. If it moves against you, okay, you could either close the position, take the loss, or depending on what type of investor you are, you may want to hold long term. You may not worry you may see this go down, like you invest 10,000 and they hold 1,200. So your available dollars here, you see how it says it's only 9,500 or whatever. That's because they're holding the deposit. So maybe your account drops below, I don't know, you're okay with it going down 20%, 30%. Me personally, if when I make a trade in the futures market, if it moves against me, I use what's called a stop loss order. So like if I buy here and I have a point where I'm going to get out, I'm going to sell it and get out and take a loss because it was a losing trade. However, in a winning trade, obviously I'm going to hold on to it and let the profits run. So I hope that kind of makes sense for some of you that are new to the S&P 500. It's a great market to trade. It's one of the easiest markets, in my opinion, to trade. And just look at this. I mean, back in November, right, of last year, if someone would have bought the S&P 500 from 32.14, look at where it is now, 44. It's actually at where's it at today? 44. We said. Well, actually, we'll round it to okay. We'll say 44.44, right? Look at that, 44.44 minus the 32.14. You're talking about a 1,200 point move in less than what? Like, I mean, that was what, November? So I mean, 1,200 points in the S&P 500. That's like $10,000 right there. So yes, there's a lot of money to make, but there's also money to lose. So make sure you completely understand futures before you get into this. Again, check out my YouTube channel if you're new to that, because I'm going to post a lot of things on there about how to trade futures for beginners. And in the next video, we'll even talk about risk management and where I think is the best place to put your stop loss orders to protect yourself from risk. That way you don't risk too much, and how to look for profit targets to get the highest reward and all of that. So that's about it for this video. If you enjoyed it, definitely feel free to like, subscribe, put your comments below, and I look forward to seeing you guys in the next one. As always, my friends, trade what you see on the charts. Don't trade what you hear, trade what you see. And thanks again for watching. Look forward to seeing you guys in the next one. Have a great day.